Welcome. Today we're diving into two fascinating types of market structures, oligopoly and monopolistic competition. These terms might sound complex, but they play a huge role in how businesses operate and how we as consumers experience the marketplace. Understanding these concepts helps us see why some industries have just a few big players, while others are filled with many competing brands. Let's start by setting the stage for what market structures are and why they matter in economics. By the end of this video, you'll have a clear grasp of the differences and similarities between oligopoly and monopolistic competition. Let's begin with oligopoly. An oligopoly is a market structure where a small number of large firms dominate the industry. These firms hold significant market power, which means their decisions can directly influence prices and output. Think of industries like airlines, automobile manufacturing, or even smartphone providers. In these markets, a handful of companies control most of the sales. Because there are so few competitors, each firm must consider the actions and reactions of the others when making business decisions. This interdependence is a key feature of oligopoly. See oligopoly in action. Imagine the airline industry. Only a few major airlines operate most flights, and their pricing strategies often depend on what their competitors are doing. If one airline lowers its fares, others might quickly follow to avoid losing customers. This creates a situation where companies are constantly watching each other and responding to changes in pricing, advertising, or new routes. The result is a market that's highly competitive, but not in the same way as markets with many small firms. One important aspect of oligopoly is the presence of high barriers to entry. These barriers can include things like large startup costs, strict regulations, or control over key resources. Because it's so difficult for new companies to enter the market, the existing firms can maintain their dominant positions for a long time. This is why you rarely see new airlines or car manufacturers suddenly appearing and taking over the market. The barriers protect the established players and keep competition limited. Now let's shift our focus to monopolistic competition. This market structure is quite different from oligopoly. In monopolistic competition, there are many firms, each offering products that are similar but not identical. Think of coffee shops, clothing brands, or restaurants. Each business tries to stand out by differentiating its products through branding, quality, or unique features. While no single firm has much control over the market, each one has some power to set prices because their products are a bit different from everyone else. Let's look at some real-world examples of monopolistic competition. Picture a city street lined with coffee shops, each with its own vibe, menu, and specialty drinks. Or consider the world of clothing brands, where each company offers its own style and quality. In these markets, consumers have lots of choices, and businesses compete by making their products unique. This constant effort to stand out leads to a vibrant and dynamic marketplace, where innovation and creativity are highly valued. Like oligopoly, monopolistic competition features low barriers to entry. It's relatively easy for new businesses to start up and join the market. For example, opening a new coffee shop or launching a clothing line doesn't require massive investments or overcoming strict regulations. This ease of entry means that new competitors can appear frequently, keeping established firms on their toes and encouraging constant innovation and improvement. Product differentiation is at the heart of monopolistic competition. Each firm tries to make its product stand out, whether through unique features, branding, or customer service. This means that even though products serve the same basic need, consumers perceive them as different. For instance, two coffee shops might both sell lattes, but one might offer organic beans and cozy seating, while the other focuses on speed and convenience. This variety gives consumers more choices and allows businesses to target specific customer preferences. In oligopoly, firms have significant pricing power, but they must use it carefully. Because there are only a few competitors, any change in price by one firm can lead to immediate reactions from others. If one company tries to raise prices, others might keep theirs steady, causing the first to lose customers. On the other hand, if one lowers prices, a price war could break out, hurting profits for everyone. This delicate balance makes pricing decisions in oligopoly markets especially strategic. Monopolistic competition, firms also have some control over prices, but it's much more limited. Because there are so many competitors, if one business raises its prices too much, customers can easily switch to another brand. However, if a company offers something unique or builds strong brand loyalty, it can charge a little more than its rivals. This balance between competition and differentiation shapes the pricing strategies in these markets. Advertising plays a major role in oligopoly markets. Since there are only a few big players, each firm invests heavily in marketing to maintain or grow its market share. You'll often see intense advertising campaigns, sponsorships, and promotions as companies try to outdo each other. These efforts aren't just about attracting new customers, they're also about reminding existing ones why they should stay loyal. The stakes are high, and every marketing move is carefully calculated. Monopolistic competition, advertising is also important, but the focus is different. Here, firms use marketing to highlight what makes their products unique. Whether it's a catchy slogan, creative packaging, or a special feature, the goal is to stand out from the crowd. Because there are so many competitors, businesses must constantly find new ways to attract attention and build customer loyalty. This leads to a vibrant and ever-changing advertising landscape. Defining feature of oligopoly is interdependence. Each firm's actions directly affect the others, leading to a constant game of strategy. This is why you often see similar pricing, product launches, or even joint ventures among the major players. The firms are always watching each other, trying to anticipate moves and respond quickly. This creates a dynamic where cooperation and competition exist side by side, making the market both stable and unpredictable. Monopolistic competition, firms operate much more independently. Because there are so many businesses, each one focuses on its own strategy without worrying too much about specific competitors. Decisions about pricing, product features, or advertising are made based on what the company thinks will best attract its target customers. While firms keep an eye on market trends, they don't have to react instantly to every move their rivals make. Sometimes firms in an oligopoly may try to cooperate rather than compete. This is known as collusion, where companies agree to set prices or limit production to maximize profits. While this can lead to higher prices for consumers, it's often illegal and closely monitored by governments. Collusion can be explicit, like forming a cartel, or tacit, where firms just follow each other's lead without formal agreements. Either way, it reduces competition and can harm consumers. Monopolistic competition, collusion is virtually impossible. With so many firms and such easy entry and exit, it's not practical for businesses to coordinate their actions. Each company is focused on differentiating its products and attracting customers, rather than trying to cooperate with rivals. This leads to a market that's highly competitive and constantly evolving, with prices and products changing frequently. Outcomes in an oligopoly market can vary widely. Sometimes firms compete fiercely, leading to lower prices and more choices for consumers. Other times they may act more like a monopoly, keeping prices high and limiting options. The balance between competition and cooperation is always shifting, depending on the strategies of the major players and the level of government regulation. Monopolistic competition, the market outcome is usually more predictable. Consumers benefit from a wide variety of choices and frequent innovation, as firms constantly try to outdo each other. Prices tend to be competitive, but businesses can earn higher profits if they successfully differentiate their products. This creates a lively market environment where creativity and customer service are key to success. Oligopoly markets can be less efficient than more competitive markets. When firms cooperate or avoid competing aggressively, prices may stay higher than necessary and innovation can slow down. However, the large size of these firms sometimes allows them to achieve economies of scale, producing goods more efficiently and at lower costs. The overall efficiency depends on how much competition exists among the major players. Monopolistic competition tends to be more efficient in terms of innovation and consumer choice. Firms are always looking for ways to improve their products and attract new customers. However, because each company spends money on advertising and product differentiation, some resources may be wasted compared to perfectly competitive markets. Still, the benefits of variety and innovation often outweigh these costs for consumers. Governments often play a significant role in regulating oligopoly markets. Because the risk of collusion and reduced competition is high, authorities monitor these industries closely. Regulations may include antitrust laws, price controls, or rules to encourage competition. The goal is to protect consumers from unfair practices and ensure that markets remain as competitive as possible. Monopolistic competition, government intervention is usually less intense. Since there are many firms and high competition, the risk of collusion or market abuse is low. Regulations focus more on consumer protection, product safety, and fair advertising rather than controlling prices or market entry. This allows the market to remain flexible and responsive to consumer needs. Innovation in oligopoly markets can be a double-edged sword. On one hand, large firms have the resources to invest in research and development, leading to major breakthroughs. On the other hand, if competition is weak, there may be less incentive to innovate. The level of innovation often depends on how aggressively firms compete and whether new technologies can give them an edge over rivals. Monopolistic competition, innovation is constant and widespread. Firms are always looking for new ways to differentiate their products, whether through new features, better quality, or creative marketing. This leads to a steady stream of new ideas and improvements, benefiting consumers with more choices and better products. The drive to stand out keeps the market lively and innovative. Consumer choice in oligopoly markets can be limited, especially if the major firms offer similar products or coordinate their actions. While there may be some variety, the options are often fewer than in more competitive markets. However, when firms compete aggressively, consumers can benefit from better prices, improved quality, and more choices. The level of choice depends on the intensity of competition among the big players. Monopolistic competition, consumers enjoy a wide range of choices. With so many firms offering differentiated products, there's something for everyone. Whether you're looking for a specific style, flavor, or feature, you're likely to find it in these markets. This abundance of options is one of the main benefits of monopolistic competition, giving consumers the power to choose what best fits their needs. Firms in oligopoly markets can earn high profits, especially if competition is limited or if they successfully cooperate. However, these profits can be threatened by price wars or new regulations. The potential for high earnings attracts large investments and encourages firms to maintain their market positions through strategic behavior and innovation. Monopolistic competition, profits are usually moderate. Because it's easy for new firms to enter the market, any excess profits are quickly competed away. However, successful differentiation can allow some businesses to earn higher profits for a time. The constant entry and exit of firms keep profit levels in check and ensure that the market remains competitive. Over the long run, oligopoly markets tend to remain dominated by the same few firms. High barriers to entry and the need for large investments make it difficult for new competitors to break in. This stability can lead to consistent profits for the major players, but it can also limit innovation and consumer choice if competition isn't strong. In the long run, monopolistic competition leads to a constantly changing market landscape. Firms enter and exit frequently, and only those that successfully differentiate themselves survive. This churn keeps the market fresh and ensures that consumers always have access to new and improved products. The result is a dynamic and competitive environment. Some classic examples of oligopoly industries include airlines, automobile manufacturing, and telecommunications. In each of these sectors, a small number of large firms control most of the market. Their decisions on pricing, product development, and marketing have a big impact on the entire industry, making these markets both competitive and closely watched by regulators. Industries characterized by monopolistic competition include restaurants, clothing brands, and personal care products. These markets are filled with many firms, each offering something a little different. The constant push to stand out leads to a wide variety of choices for consumers and a steady stream of new products and services. For consumers, oligopoly markets can be a mixed bag. On one hand, large firms may offer reliable products and services, but on the other, limited competition can lead to higher prices and fewer choices. The impact on consumers depends on how aggressively the firms compete and how much regulation exists to protect consumer interests. Monopolistic competition, consumers generally benefit from more choices and frequent innovation. The constant competition pushes firms to improve their products and offer better value. While prices may be slightly higher than in perfect competition, the variety and quality of products often make up for it. Entering or exiting an oligopoly market is challenging. High startup costs, strict regulations, and established brand loyalty make it tough for new firms to break in or for existing ones to leave. This creates a stable but sometimes stagnant market where the same players dominate year after year. In monopolistic competition, entry and exit are much easier. New firms can join the market with relative ease, and those that don't succeed can leave without huge losses. This fluidity keeps the market dynamic and ensures that only the most innovative and customer-focused businesses thrive. Branding is crucial in oligopoly markets. With only a few competitors, firms invest heavily in building strong brands to differentiate themselves and maintain customer loyalty. This can involve everything from memorable logos and slogans to sponsorships and celebrity endorsements. A strong brand can be a powerful tool for maintaining market share. Branding is equally important in monopolistic competition, but for different reasons. Here, firms use branding to highlight what makes their products unique and to attract specific customer segments. Creative branding strategies can help a business stand out in a crowded market and build a loyal customer base. One interesting feature of oligopoly markets is price rigidity. Because firms are so interdependent, they're often reluctant to change prices, fearing that competitors will quickly match any move. This can lead to stable prices for long periods even if costs or demand change. Price wars are rare but can be intense when they do occur. In monopolistic competition, pricing is much more flexible. Firms can adjust prices frequently in response to changes in demand, costs, or competitive moves. This flexibility allows businesses to experiment with sales, discounts, or premium pricing to find what works best for their target customers. Customer loyalty is a major asset in oligopoly markets. With only a few choices, firms work hard to keep their customers coming back. Loyalty programs, exclusive deals, and consistent quality are all strategies used to build and maintain a loyal customer base. This loyalty can make it even harder for new firms to enter the market. In monopolistic competition, customer loyalty is built through differentiation and personal connection. Businesses strive to create memorable experiences, unique products, and strong relationships with their customers. This personal touch helps firms stand out and encourages repeat business, even in a crowded market. Sum up, oligopoly and monopolistic competition are two distinct market structures with their own characteristics. Oligopoly features a few large firms, high barriers to entry, and interdependent decision-making. Monopolistic competition, on the other hand, has many firms, low barriers to entry, and a focus on product differentiation. Understanding these differences helps us make sense of the business world and the choices we face as consumers. Knowing how these market structures work isn't just for economists. It affects the prices we pay, the products we buy, and the choices we have as consumers. By understanding oligopoly and monopolistic competition, we can better appreciate the forces shaping our economy and make more informed decisions in our daily lives. Thanks for joining us on this journey through oligopoly and monopolistic competition. We've explored how these market structures shape industries, influence business strategies, and impact our everyday choices. Remember, the world of economics is all around us, and understanding it helps us navigate the marketplace with confidence. Stay curious and keep exploring the fascinating world of business and economics.